Hello.
Well, there you are.
All right, what are you guys doing here? Wait, hold on. Hello? Wait, hold on. I don't hear anything from you.
Okay. You're invisible.
I'm here. Do you, let's see, you should be able to hear me? Can you hear me?
We can hear you.
Well, yes, here, you can hear me. All right, I have some confirmation that I can be heard. Aha. Chat, very clever. Hello? Hey. Oh, you muted my microphone. Okay. Okay, well, I'm here. Should I hang up the phone or what? Hello? See, I don't have any sense that, that, well, I can't hear you. I think that must be the biggest problem. Maybe I can turn up my volume. See. Oh. somebody could say something over the Hangout. Oh,
Nope.
wait a minute. I'm hearing something.
We can hear you.
Hello. Okay. Okay. All right. Okay. Right. So I assume that you all can hear me. It's a very sort of complicated setup here. I'm listening to myself talking over the phone, I think. What? Yes? Hello? All right. So should I go ahead? Okay, hi. So thanks for having me. My name is Stephen Pav. As part of my background, I'm a former applied mathematician. I'm actually a graduate of Indiana Bloomington. This is my first time back, as it were, for many a year. So for about 9 years, I was a quant programmer and a quant strategist at 2 different small hedge funds. And these were actually sort of very small, purely quant-based machine learning funds that were trading in the U.S. equities, so-called single name equities, and in volatility futures strategies. I probably hold a world record for the number of hedge fund jobs found on Craigslist, which is 2 of them. So in my years developing quant strategies, we looked at a number of different machine learning technologies to construct strategies. We started with support vector machines and regression and support vector classification. We tried random forests, naive Bayes. We pursued genetic programming for a very long time. And we also looked at some traditional statistical approaches, such as plain old linear regression and logistic regression. But whatever the approach, we used backtests a lot. And genetic programming, for example, used them heavily. So genetic programming is basically you have a bunch of spaghetti that you throw at the wall and you figure out which one's best, and then you combine the best spaghetti together. And in our case, the spaghetti was something that took data and created trades, because that is the sort of workflow of a quant fund. You take data, you create trades out of them. So what makes a profitable quantitative strategy? Well, obviously you need some prediction of future price movements, but also you have to turn those predictions into trades. But it's actually a little bit more difficult than that. People sort of think, going into it, at least I did, that once you have those predictions, it's pretty much trivial what happens next. But you really need to think about what a trade really is. You don't just buy and sell at the sort of closing price that's given in the tape. You have to submit an order of some kind. A market order probably isn't the best way to do this kind of thing. So you have to think about whether you're submitting a limit order or some sort of conditional order. How exactly are you going to turn these things into trades? This is something that you kind of need to think. You'll also need to eliminate or reduce exposure to certain risks, and those are determined by, for one, the offering materials of your fund, what you've sort of promised to investors, what kind of risks you would take and what you wouldn't, as well as your ideas about what things you can forecast and what things you can't. And you'll also need to sort of control your trade costs. So these include commissions, short financing. So by that I mean if you're going to sell something short, you actually have to borrow it ahead of time, and that costs something. And then there is market impact, which is famously nebulous and hard to model. Together, it's hard to estimate the effects of all these different moving parts separately. Different strategies will have different exposures, for example, to trading costs. So you might have a strategy that turns over more often than another. And you may have strategies that work in different spaces of liquidity. So we sort of think of market impact as being dependent on the amount of volume in a given name. And so different strategies may have different exposures to that. So it's hard to reason about those things without just doing a full-on simulation. So you simulate your trading historically, and that's what I'm calling a backtest. Now, basically, a backtest implies that you're talking about a quantitative strategy. You really can't backtest discretionary trading. If you have some guy on your desk and he says today, I like Apple and I don't like Sears, so I'm going to buy Apple long and sell Sears short, you kind of don't really know what he would have done a month ago or a year ago, unless he was just saying the same thing. So it's sort of hard to backtest just that guy. So backtests sort of go hand in hand with quantitative strategies. So what should a backtest do? A backtest probably should simulate the effects of your actions. Your actions are the orders being submitted. It should simulate the actions of the world. So these are fills of the orders that you have submitted, commissions, short costs, corporate actions. By corporate actions, I mean splits and dividends and other oddities, which I will get more to later. The backtest should probably translate in an obvious way to a real trading strategy. So that should be apparent that you'd want that to happen, but sometimes we found that we had developed backtests of things that we weren't really clear how we were going to monetize. And probably the most important thing is that a backtest should provide an absolute guarantee of time safety. And by time safety, I mean you are simulating historically what you would have done at a given point in time. And so your simulation must guarantee that you aren't pretending that at a point in time you would have had information that you really wouldn't have had at that time. So creating a good backtesting environment requires a few kinds of skills. So for one, there's a software engineering skill. To create an environment like this, you're going to need to balance time safety, for one, computational efficiency, and developer sanity. So it's pretty easy to create a system that is guaranteed to be time safe and is fairly easy for a developer to use. At any given point in time, it only gives you access to the data that you would have known at that given point in time. You write some callback that simulates your actions at that point in time, given that data, and then it steps forward day by day. But it turns out that a program of that kind is going to be probably very slow. It's not going to work for genetic programming, as we'll talk about later. So there you're trading off computational efficiency for time safety and developer sanity. Oftentimes people work for computational efficiency and developer sanity, and then they're always losing out in time safety. So it's easy to create something that's computationally efficient, vectorized, and sort of easy to use. It's these sort of high-level operations on time series, and you'll end up with a backtest that looks very profitable, and in fact, often it'll look insanely profitable, and you realize that you're actually not time safe. A good backtesting environment also requires a fair amount of domain knowledge and data. So when I first started at a hedge fund, none of us, it was a bunch of academics, basically, and none of us knew anything about the markets. So we asked people who were trading quantitatively, like, how should we simulate fill? How should we simulate market impact? And people would tell us different things, like, oh, you should expect that your movement in the market is going to be 3 bips. Or sometimes they would say 50 bips, or they would say 100 bips. A bip is a 100th of a percent, so it's a basis point is 10 to the negative 4th, essentially. Nobody really had a good answer. Well, actually, they were all very good answers because it was really a stupid question. It's like asking how long a string is. So we didn't really have that kind of domain knowledge. You need that in order to set up your simulations in a sane way and also have them act or react to your actions in a reasonably unbiased way. You'll also need to know a lot about how corporate actions work, what kinds of corporate actions you should expect to happen, and how you're supposed to deal with them. The third thing that you'll need are great statistical powers. So you'll need to know how to interpret your results, and most importantly, how do you avoid overfitting. And the last thing is good intuition and sleuthing abilities, because at least at the beginning, the thing that you're going to make the most is not profits, but errors. You're going to screw everything up. And every time you add a new feature, you're basically going to add a new broken feature. All right, so let's go ahead. So I think of there as being not just one kind of backtest, but a number of different kinds of backtests. And I put these in a triangle for some reason. This is a weird looking graphic. I don't know why I made this. But at the top of it, you have things that are sort of higher fidelity. They're more accurate representation of what a trading strategy would look like. But the things in the bottom are actually much faster to compute. So at the very top, we have full simulation, which is more or less like what you would see from Quantopian Zipline. It's an open source backtester simulator. And it's of the variety of, we're going to drop you in at a given point in time, and you'll have access to all the data, and you submit some trades, and then we'll walk forward. We had something that, I wrote something that was like that in MATLAB, and those were reasonably slow, but we always had to run those for a strategy before we deployed it. In fact, the way that we set up that system, the callback function, the thing that would wake up every day in the simulation, could also actually trade in real time. So we wrote a real-time harness that would every day actually really wake up with the real positions and the real data and call the callback and get the actual trades. So that actually shortened the amount of time of deployment, because we were in a production mode, as you might say, where we could very easily prototype code and then move it into production because it was the same deliverable piece of code. So on the opposite part of that triangle, we have what I would call path-independent backtest. So it's sort of weird to call this a backtest, but if you think about having a time series of predictions of returns and another time series of the actual returns, you could compute the correlations among those two time series. Now again, it's a multivariate time series, so it's a vector every day of predictions and a vector every day of actual returns. You could compute that correlation in a way that's path independent, by which I mean you could farm out every single different day to a different core on your computer. They don't need to sort of know about each other. And that's the crudest form of backtest. It's a simple, matrix element-wise multiply and summation operation. It's very fast, but it has none of the nuances of the things that you would call in a real backtest. The point of this triangle, I should go back. The point of having things that are higher fidelity but slower computation and vice versa was that if you had some idea of forecast that didn't work at the bottom, if it really had no predictive ability in a sort of path-independent arena, if it had no correlation, there was no point moving on to full simulation. And similarly, as you moved up this triangle and you got higher fidelity, things that had looked good below suddenly would no longer look good, and you would have no reason to go through the effort. So because we were working in genetic programming, we mostly lived at the bottom of this triangle. We would look for things very quickly in this sort of path-independent world, and as they sort of passed that first test, then you would sort of move up the triangle and trade off. The next layer up from path independence is what I would call scale independent. So this is a path-dependent backtest. So what that means is you would start out with some fixed number of dollars, and you would trade according to some signal, and every day it would figure out basically what your trades were. So you would move from one allocation to another. That's not path independent. You need to know on any given day what your previous holdings were. The point of this is that we were actually charging you for things like commissions and basic turnover. So a strategy that was very high frequency might look good in the path independent space, but it had basically no commissions applied. Once you get to the next layer up, suddenly the effect of all that turnover starts to hit you, and you realize that it's not profitable. I call that scale independent because in actuality, the way those were simulated, the amount of starting dollars didn't really matter. So it was basically, a numerator of 1, or maybe we called it $1 million or something. But the simulations of market impact were flat. It was always something like 3 bips or 5 bips. In reality, people model market impact as depending on the amount of volume that you're taking. So if you're trading at $1 million a given strategy versus if you're trading the same strategy at $100 million, obviously you're taking more liquidity away, and you're going to have a larger market impact. In the scale independent space, we basically ignored that. We were just looking at flat out commissions and a basic kind of turnover. So in the next layer up, you were using you were basically charging us. Oh, I'm getting dinged. My audio level. Okay. So in the next layer up, you were basically being charged for what your starting amount was. But the point is that there you needed to feed in data that told you things like what was the actual volume, what was the liquidity. So there were greater data requirements at that layer up. In the scale independent space, you just needed to know basically the returns. So that's why you had a slower computation. And again, back at the top, you had full simulation. You had this thing that would do callbacks. It would do splits for you. It had to have the same format as the thing that you would actually call in real trading. Now, for us, we were trading like once or a few times a day. We weren't at a high frequency space. So if that callback took 10 seconds, once it had all the data marshaled, that wasn't a big deal. In fact, we could even do something like call an optimizer, which would take maybe 15 or 20 seconds to, I'm getting dinged a lot. Path independent. Our sound ripped out for about 30 seconds. Okay. All right, thanks for dinging me. So path independence basically means that the alignment of the predictions and the returns could be farmed out to different cores, say, of a machine. They don't need to know about each other. So we're not looking at the amount of turnover that would be implied by a strategy that somehow trades on that prediction. You're just looking at the raw prediction itself. So you basically don't need to know that your prediction is very high frequency. It might imply that you're turning over all of your money every single day. The path-independent simulation doesn't really care about that. Once you get to the next level up and you start simulating what your commissions would be, then you start to realize that this is not going to be profitable. Should I move on? Oh gosh, I hear that. Oh, I see. It's over the headphones. Okay, great. I think the chat's going to work better for getting feedback from you. Okay, so I call this Garbatrage. So if you think about Bayes' rule, devising a consistently profitable trading strategy is known to be hard. In fact, the efficient market hypothesis essentially assumes that it's impossible. You've probably seen lots of books about quantitative trading. People talk about it all the time, but it's not clear that there's any one person that is consistently doing it right. And not even quantitative trading. I think trading in general is known to be difficult. It's a difficult enterprise for humans and for computers. On the other hand, programming is also hard. You go to a bookstore and you'll see a lot of books about programming. Everyone talks about it. How do we teach people to program better? There are all these different ways, pair programming, test-driven. Everyone has a new good way to become a better programmer because basically programming is hard and we all suck, right? So bugs are easy to make. Profitable trading strategies are hard to make. So if you think about Bayes' rule, if your backtest looks profitable, what is the likelihood that this strategy is really profitable? Well, it's probably pretty low. In fact, the EMH people would say that it's still zero. That if you have a backtest that looks good, in reality you have a broken backtest in some form. So you should probably keep this in mind. If you're exploring a new asset class, using a new fill simulator, new code, testing a new strategy, anything that you do that's new, if your system seemed to be working before, you add some new thing to it of some form, or if you're reading a paper from a third party, whatever, if the backtest looks good, it's probably a bug. So I couldn't resist trotting this out. I don't even know what to say. Well, there's a paper that claims that if you look at 3-day-old tweets, in fact, somehow I think it's supposed to be how calm people were 3 days ago, that gives you tomorrow's Dow Jones Industrial Average movement with a probability of 88% or something like that. So if you actually applied that trade, again, we're going to sort of ignore costs, to a market timing model, you would get this kind of return. It would turn $1 million into 10 to the 14th in a matter of, I don't know, 20 years. Probably, sort of appealing to this Bayes' law argument, probably there's something wrong with this. And it's not just the commissions. Okay, so moving on. Time travel. Time travel is my term for the most common error in backtests. It's the use of future information in simulations. So it occurs for a number of reasons. You have backfill and survivorship bias. You have representation of corporate actions, dividend splits, spin-offs, mergers, and warrants. And you have thinkos and code boo-boos. And those thinkos and code boo-boos, I mean, that's related to this trade-off that I was talking about before, where you're always trading off time safety, developer brain damage, and efficiency of the code. So whenever you try to cut corners and make your code more efficient, you probably, there's a danger that you're going to introduce time travel, or you're just going to drive yourself crazy, right? So time travel, it turns out, is easy to simulate, but it's hard to implement in real life, right? That's not a real effect that we've discovered yet. And if it were, I'm not sure I'd be talking about it or trading on it. I guess I would be trading on it. So what is survivorship and backfill bias? These are the sort of classic biases. The one that everyone sort of knows about, the classic survivorship bias, is when you're trading on a universe of stocks that's defined by the present membership in some index. So if your universe of stocks is today's S&P 500 and your backtest goes back to 1995, you wouldn't have known at that time for some of those names that they would be in the S&P 500 now. And if you have a long bias, then lo and behold, your backtest will tend to look good. That seems like a silly thing that no one would ever do, but there are more subtle versions of that. So, for example, data vendors, they'll often backfill data for companies for you. They'll introduce this bias without you needing to ask them to. And the reason they do this is not because they're evil or stupid. It's that oftentimes they'll have clients that will call them up and say, hey, where's the data for this company, XYZ? And they'll say, oh, right, that's not in there. Well, that's an important company now. Why don't we add them? And they'll go back and research them and figure out what the data would have been, perhaps, and there you are. Suddenly you have this bias. You can test for that effect. It turns out there's a sort of interesting way to test for that using logistic regression, but you could also just ask them. It turns out we went the long way, and then we presented it to a vendor, and then they said, yeah, we do that all the time because people ask us. It also turns out that vendors can do weird things to deal with mergers. So, for example, if you have a vendor that's giving you, let's say, fundamental data, what do they do for two companies that merged? Historically, what should they do? It's not clear what they should do at the time before they merged. Should they give you the two stocks separately? Probably they should, but it's not clear how you're going to deal with that. And that feeds into the sort of next source of time travel, and that's corporate actions. So corporate actions are notoriously time leaky, as I would say. And the problem really stems from trying to represent asset returns or any kind of data as a single time series, whereas in reality, they kind of branch across time. So if you go backwards and forwards in time, you'll have mergers and spin-offs, things where returns shouldn't really be treated as one thing, but we always try to treat them as one thing. Corporate actions are just hard to model. So the example that I have is from this company, Dennis and Mines. We were stuck in a position, I think, no, it was a different one. Anyway, if you read this, there's this crazy stuff about under this agreement, each share is exchanged for 0.26 of a common share, one common share of SpinCo, which is a great name for this kind of thing. 1/2 of a warrant to acquire an additional SpinCo share at a price of $5 for 6 months. And then they talk about how outstanding warrants and options are automatically exchanged for option warrants of Denison and SpinCo at a given exchange ratio of 0.26, blah, blah, blah. So if you go back to where you were, or actually me thinking about where I was when I first joined a quant hedge fund, I thought, oh, we'll just predict returns. Well, of what? How do you predict? What is even Denison Mines when you think about that thing? It's what are its returns over the next month? Like you can't really predict that from that word salad of different kinds of instruments. Another example of time traveling corporate actions are back adjusted closes. And again, this goes back to this idea of efficiency and having a fast backtester that deals with a single time series. So if you go look on, for example, Yahoo Finance or Google Finance, I think this came from Yahoo or from Quandl and Yahoo. They create this thing called adjusted closes, where they deal with splits and dividends. This is, if you had $1 invested, well, I guess it would be around, in mid-1991 in Microsoft, then now you would have, $90 less what your broker would have been charging you all this time. So it's the effect of a dollar where the dividends are continuously reinvested at some, defined in some way. That is what an adjusted close is. And they typically always backwards adjust them. They'll do this on the popular finance sites so that at a given point in time you could just use the adjusted close and you can compare it to sort of recent values if you so desire. But it turns out that if your model has access to this data, this is just out and out time traveling. So if you if you were investing inversely proportional to this adjusted close, and Microsoft was in your asset universe, well, lo and behold, you would have the benefit of this future information, because here you have a stock that, companies like their stock to trade within a given range, and 10 cents is not within that given range. Even if Microsoft had been in your universe, you wouldn't have known at that point in time, back in time, that it would have done this fantastically well over the next 20 years. So you have introduced this this time travel by looking at adjusted closes. I hope that was clear. That was a little not well put. Okay, there's another kind of time travel, and I call this the machine learning hacker trap. This is something that I've fallen into. I've seen other people reinvent this a number of times. So when you're training machine learning models, you need to, of course, align your returns to features. So if you sort of look at this plot, if we think about daily movements, if you look at the daily movement of a stock over Tuesday, you kind of need to know that by or just before the close of trading on Monday. So you'll see there's an alignment of Tuesday to price movements on Tuesday to the features on Monday. This is standard kind of stuff. You always, we were always doing look back kind of time alignments in our time series because that was always generally considered to be safe. The problem is that people, myself included, having done this, forget that your model is essentially time-stamped as of the returns and not as of the features. So what does that mean? If you think about, okay, I'm going to train my model on Tuesday, so I take all the data up to Tuesday, and then I take the returns that align with those, and suddenly I'm using data from Wednesday. I'm using the returns from Wednesday. If I then go on and use this model, and I say, oh, well, I trained it as of Tuesday, so I must be able to train on it on Tuesday, I'm using the future information of Wednesday. So one way to detect this kind of thing is when people, your quant comes to you and says, this is great, the more often I retrain, the better my model looks. And in fact, they'll often say things like, oh, there's always this, there's this time recency effect where I need to throw away the old data, really old data doesn't really matter. I'm only using like a 1 week training window. So if you train this model every day and you only had 1 week of data, then suddenly that one Wednesday is becoming 1/5 of your training set. Suddenly your model is becoming more and more just this fake time travel. Okay, so I thought we would turn it over to Zach to talk about the sort of low latency world of high frequency trading that he works in. He probably will be able to tell you things about fill simulation and order book and all that kind of stuff. And then time permitting, later on we can talk about overfitting. I have some slides about that, which is another important effect. So I think I'm going to go on mute unless there are any questions. I don't see Zach. Is that what you're saying? Hello? Okay, Zach is not. Okay, the Q&A for me. All right. It's really hard for me to hear you. Okay, that's better. Yeah, so we. Oh, can you hear me? All right, you can hear me, right? I don't think I'm muted. I think you're probably low. You probably turned down your volume there. Okay, so the question was regarding this Microsoft example. When you look backwards in time, if you were trading at the adjusted close price, then and you were looking at commissions, you would be trading more shares, and so you would have a larger effect. And the question is, wouldn't that offset the bias? Well, two biases won't necessarily always balance each other out. You're right; they're going to work in the opposite direction. In the code that I wrote, in some of the simulators, in that sort of triangle of simulations, they would have access to not only the closes but the adjusted closes, and so we were always basing the commissions off the actual closes. And then we were using the adjusted closes to do the computation essentially of returns, so that we never had to think in that process about what would happen to a split or a dividend. We always assumed that dividends were reinvested at a given rate, and splits were more or less transparent, and any kind of weird merger or spin-off we kind of ignored in a sane way, or we would merge the returns series as necessary. So in reality, well, so it depends on your backtester. Yes, if you were only looking at adjusted closes, then it would seem like you were trading more shares, and then that wouldn't look great. We tended to have a well, we we avoided this form of time travel on the adjusted closes. We did not feed adjusted closes into as features into our models. We would compute returns, which are more or less safe. There's no leakage of forward information as far as I can see from the returns, and we would use those in constructing our features or our predictions. Zach has the flu, I see. Our universe construction was based on the actual closes, as well as a bunch of other things. So, what stocks would you have known about at a given time, and then we wouldn't trade anything that was below a given price, simply because of this problem of commissions being too high. Anything that had volume that was too little, we wouldn't trade. And then there were, as we tested out strategies, there were other kinds of niche areas that we looked in terms of the sort of close and volume space. There were times when we said, oh, we don't think we can predict things that are very highly traded, and we would remove those for some reason. But yes, if you are only simulating on the adjusted closes, you need to be careful with your commission models to be sure, as well as if you're using it in your features. So again, it's interesting if you create this kind of time traveling boo-boo. If you make a simulation that knows the adjusted closes ahead of time, and you're investing inversely to them, what you'll see is your edge, basically your Sharp, will decrease linearly over time. So there's a lot of this time leakage if you look back. If your simulation starts in 1985, there's a lot of this potential future time leakage that you have, and as you move forward in time, suddenly there's less of that future leakage potentially that you'll have. So if you look at the Sharp, it just sort of linearly decreases. So that's one way to kind of test for that effect. Okay, other questions? Yes, I'm ready for the question. Yeah, so the question was, for example, Microsoft has given out some big dividends. How do you deal with cash dividends? Simon's right. There are a number of different kinds of dividends that companies give out. Usually, it's just cash or shares. Sometimes a share dividend is a little weird. It's really just a split with non-integral split amount. But yes, we would assume that you were reinvesting the cash at a given price. Now, for some names, this would result in pathological cases in our data. So you might have a stock that was trading at 19 cents, and it would issue a dividend for 25 cents. What do you do with that? That doesn't really make any sense, right? That shouldn't happen. And what we would have is going backwards in time. Suddenly you would have an adjusted close that was negative, which is great if you were computing log returns, because the way we computed log returns was we take the log of everything and then cumulative difference, or rather element-wise difference everything to compute the log returns. So you can't take the log of a negative number, so we know we'd have imaginary numbers in there suddenly, and that's how we, pretty early on, discovered this problem. It's why would a 19 cent company issue a 23 cent cash dividend? Well, maybe they announce that they're giving out a 23 cent dividend, but it's such a crappy company nobody wants to buy it. Like, why would you buy something that's known to be giving out 23 cents at a given point in the future, and is basically worth nothing after that? You wouldn't buy that at all. So the 19 cent price is just sort of stale. Like, maybe some idiot bought it for that, or maybe it was just a stale price, or maybe it was just a quote, right? Who knows? But yes. Yeah, so right, that is another excuse me? Yes. Yes. Yeah, so the point given over the phone, for those of you not on the phone, is that there oftentimes, if you look in an option chain, you'll see that there are prices given, but they're just really stale. They could be very old, and so things that mathematicians would say have to happen suddenly aren't happening, or you'll get negative implied volatilities, things like that. Those will quickly shake out when you try to actually trade on them, but you don't see that in the data, right? You just see the data as it was, or as it was recorded. You don't see the effects of what you would have done had you had done it at a given point in time, because you didn't. So. No other questions? Okay, yeah, sure. Okay, so let's see. I'm eating an orange. So I was going to turn it over to Zach. There's this. I've never. Well, I guess I have a few times. This has happened to me, and this doesn't happen just because of broken backtests. Not because of technically broken backtests. It's after a while of working on this, you sort of figure out a way to create backtests that are more or less unbiased for what they are. They aren't time traveling. You figure out how to approach fill simulation in a kind of same way, using your actual trades data, and so you have a reasonable model of what would have happened, and then this happens. And probably a lot of this is attributable to just plain old overfitting. So once you fix your backtests, you can move on to overfitting. To me, overfitting has two sort of distinct flavors. And the first is you're building a decent model for the assets in question and the features that you're using, but you're overestimating your future performance based on your in-sample data. So you're basically using the same data to build a model and estimate its Sharp. So did I describe Sharp? Yes, I did. Okay, so I described it later. I'll get to that. But this is, classical in-sample bias that you often see. And it turns out that there's another sort of sense of overfitting, and that is, as you add opportunities, it actually decreases your expected Sharp. So for right now, if you don't know what Sharp is, just think of it as the magic utility units that you want to maximize. I'll get to it later. So there's a paper I wrote a while ago that extends the classic Kramer-Rao bounds to the case of portfolios, and it basically says that as you add more assets, your expected Sharp can decrease, and it tells you exactly why and when that should happen. So these two things lead to what I'd call a quant's koan, and that is ignore your data and your model is suboptimal. Use all the data, your model is suboptimal. If there are any of you out there who speak Chinese, hopefully maybe you could reduce this to an 8-character koan. But what I mean by this is that if you consider the if you consider the first part of it, if you took all the data if you took all the data for your universal, the returns data, and you said, oh, you know what, I'm going to split it in half, and I'm just going to ignore half of it when I'm building my model. Well, your model would be suboptimal, probably. But the second part of it basically says that as you add more opportunities, as you add more assets to your universe without controlling the degrees of freedom, then you're actually losing out. I don't. Well, I shouldn't say anything more than that. You can read the commentaries from Moon, I guess. So, in my opinion, overfit is not cured by silly machine learning tricks. As far as I'm concerned, you can talk about holdout sets, in sample and out of sample all you want. In reality, there isn't, as far as I feel, there is no out of sample. There's in sample, and there's trading real money on the strategy. Anything else that you do with the data that you have right now is really just in sample. You can divide it up all you want and pretend that you're going to not see part of it and then simulate it on the other part. But in reality, your deployment decision today is based on all the data that you have available to you today, and either you have to deal with whatever bias you have by using all the data that you have today and building your model with all the data you have today. I feel that overfit is sometimes approached as a technical problem. I mean, if someone writes a paper, obviously it has to be they have to pose it as a technical problem. They can't just complain about how your process stinks. But fighting it really requires discipline and soft engineering skills. So, for example, if you don't keep track of everything that you've tried, you can't apply most of the techniques. So what I mean by that is, oftentimes when you're developing a strategy, let's say you're thinking about a basic sort of technical strategy. You say, oh, I believe in momentum, so I'm going to look at a momentum strategy. And then you start testing it, and it doesn't really work, but you, for some reason, find that it works in a given sector. So you say, oh, you know what, I'm really only interested in momentum in this given sector. And then you find that, well, really, if I combine it with mean reversion in this other sector, and then you start adding, all these weird hedges, and I'll have no exposure to this thing, and then I add this filter on it to slow it down because I have momentum at different scales. If you don't remember all the things that you tried, and you just look at your final backtest, really you've just been hill climbing that whole time on your in-sample data, and it's a subtle form of time travel. You can get a backtest out, and it can look great, but it's a backtest of what you would have done at a given point in time in the past if you had known what you know today about it ending up looking good. So you need to keep track of all those different kinds of things that you have tried. So I'm going to talk about my technical approaches to this problem. So I'll get a little bit technical here, and this might not go over so well. So as an approximation, we're going to suppose that the returns of an asset, so a strategy, for example, or stock, an ETF, or whatever, are constant over time. They're just stationary, essentially. And I'll use mu as the expected value, so the mean return, basically, and sigma squared for the variance return. So volatility of the return stream is going to be sigma. So informally, we define the Sharpe ratio as mu minus R0 over sigma, where R0 is the risk-free rate or the disastrous rate of return, whatever rate of return you want to do better than. Formally, I tend to use Sharpe to refer to the sample statistic, and I use signal-noise ratio to refer to population quantities, but I'll try not to be so pedantic here. I'll try to make it clear whether I'm talking about a sample statistic or a population quantity. So if you haven't heard of Sharpe, the one takeaway from this talk is that Sharpe ratio is important. Like I said, I've worked at 2 small machine learning quant funds, and Sharpe ratio was basically the main metric by which potential clients, figured out whether they wanted to invest with us. There were other things that they wanted to know, like, do you have exposure to the market? What things are you trading in? What's your, maximum exposure to blah, blah, blah. But in reality, Sharpe was the thing that they cared about. And if you were just starting out, it's important that in your live trading in your first, year or 6 months or 18 months or whatever, that your Sharpe ratio be fairly high. If you want to sort of survive in the long term and get clients. So this is definitely the thing that you should aim to maximize, at least do a first order approximation. There were 2 technical forms of the problem that I was interested in. So like I said, we used automated strategy search techniques, for example, genetic programming. And in this case, you think about the problem as, okay, I've observed the in-sample Sharpe of n strategies where n is bigger than 10,000, maybe as much as 1 million, say, and I might have selected these strategies by hill climbing the in-sample Sharpe. And the question was, could we somehow debias the Sharpe of the optimal one? So we picked the one that had the best Sharpe in sample. Could we figure out how to unbias that estimate based just on that in-sample Sharpe and the number of things that we tried? Or could we alternatively select some top K of them and average together the strategies and have an unbiased estimate of it? So that was one form of the problem. That was useful for us and might be useful for some of you. The other was in the sort of more mundane area of human strategy search, or what they call the graduate student descent. And that is, you've observed the returns of a smaller number of strategies, let's say 1,000. So you have somebody who's trying a bunch of different things. They're being very conscientious, so along the way they're recording the returns of every single one of them, or maybe, just maybe, ahead of time they figured out, here's the different knobs that I want to test. They set up an experimental design and actually then tested them according to that design, and they recorded all of those returns. And along with those returns, they have the settings of some knobs for each of them. I'll talk about more what I mean by that later. So the question is, can we then estimate the effects of each knob? So you can think of a knob as being like, I'm trading momentum, and how do you define momentum? Well, it's the returns over the past K days. And so K is kind of a knob that you might tweak. Oh, I'm going long in this, I'm having 0 exposure to these 5 factors. Well, how do you select those factors? That's kind of a knob. I'm going to try this weird estimate of beta. It's parameterized by these 3 things. How do I select those things? Well, those are knobs. So they're the free variables that you have in your gray box. So the question was, if somebody sets up a system like that, they test things in sample, they collect all the data, they've done the right thing in terms of saying ahead of time, these are just the things that I'm going to test and no more, and they've collected all the data and they've given it to you, and they say, okay, can we pick the best knob setting and unbias or debias the estimated future Sharpe, and can we figure out which of those knobs are really important? So for both of these problems, I suspected, I think I was right, that the classical approaches, and by that I mean White's reality check and its extensions, Romano, Politis, and Wolf. Hello? Did I drop out? No, I think I'm still here. And Hansen's SPA, Superior Predictive Ability Test. I suspected that those would not work. So they take a different kind of input, or there was a wrong assumptions, or they wouldn't scale. So, for example, for the automated strategy search, we didn't even really have the return streams. We just had the sharps of all of them because you'd throw them away. You know, you were collecting 1 million of them, you wouldn't collect all of their return streams. Most of the reality check tests require you to have the return stream because they're going to bootstrap them. Wrong assumptions, so most of them couldn't deal with in-sample hill climbing. They're based on bootstrapping. They weren't going to scale to even 1,000 different strategies. So how would I deal with these? So for the first problem, let's say that you have the time series of the returns of n different strategies, and each of them are of length t. And we're going to put them in the t by n matrix X. So every row is a day and every column is a strategy. Now I said before that we were going to throw away these time series. So this is a sort of what if kind of consideration. Later on we'll see that we don't actually need X. But let's pretend that we actually had collected all of them. These are an X. If you think about how a dimensionality reduction works, right? Dimensionality reduction is sort of a classic technique. Well, we're going to say that X is nearly contained in some k-dimensional subspace with k much smaller than t even. So you're going to say X is approximately equal to L times W, where L is t by k matrix, W is a k by n matrix. So the columns of L are now the time series of these sort of latent returns, and W are the loadings of all your different backtests of your strategies on those k different things. Okay. So the question then becomes, what is the maximal Sharp over k assets? So remember, I was thinking about what's the distribution of the maximal Sharp over X, right? We're looking at this matrix X. I did a dimensionality reduction, and now it's looking actually more like just a linear portfolio problem, right? It doesn't matter that the columns of X are correlated. That structure is fine within this model, right? The W allows each of your different columns of X to have different mixes of the different columns of L, and so they can be correlated. So the question becomes, what is the maximal Sharp over k assets? Well, it turns out that the optimal Sharp over k assets is achieved by the Markowitz portfolio. The Markowitz portfolio, I won't define it here, but the distribution of it is related to Hotelling's t squared. So as an aside, this is one of the most satisfying things of my career in quant finance, is seeing that there are all these connections between things that are interesting in the quant world and sort of classical statistics. So on the one hand, in quant world you have Sharp ratio. Its analog in statistics is the t statistic. So if you go back and look at this definition of Sharp ratio, mu minus R0 over sigma, if you introduce a square root n term there, you just get the t statistic out. So the Sharp ratio is just the t statistic up to rescaling. And similarly, the squared Sharp of the Markowitz portfolio, so you're expanding from a single asset to k assets. The test for that is Hotelling's t squared. And it turns out that the squared Sharp Markowitz portfolio is equivalent to Hotelling's t squared. Again, there's a factor of square root n or n in there. And then you can move on to an even weirder model where you're looking at the returns as being conditional on some state variables that you can observe. And so you have a linear conditional expectation, and you have constant covariance. You're computing the expected, again, this is expected under your state variables, squared Sharp conditional on the features. You get this thing called the Hotelling-Lawley trace, which is the statistic that's used for testing a many-to-many regression. Anyway, I think that's neat. So going back, the optimal Sharp over k assets is achieved by Markowitz portfolio. It's distribution related to Hotelling's t squared. So it turns out that the distribution of the in-sample Sharp of the Markowitz portfolio is a function of K, which is the number of assets, T, the amount of time, and the actual population Sharp of the population Markowitz portfolio. That's the real effect that you could possibly capture. Hotelling's test, as it's normally quoted, is a test of whether that population Sharp of the population Markowitz portfolio is 0. And that can only occur when the mean of all of the L's, in this case, are all 0. So every single column of L, if that's 0 mean, your X is also going to be 0 mean, if that approximation was an actual equality. There's no effect there. There's nothing to capture. Everything is 0 mean, and so any portfolio on them is also going to be 0 mean, no matter what you do. Okay, so that's the sort of vanilla version of the Hotelling t-squared, but it can be used to test for whether that total effect size is something other than 0. So we have good estimators of and confidence intervals around that population optimal Sharp. Once you know the given, once you know the in-sample statistics, and those in-sample statistics are going to be, in our case, the maximal Sharp over columns of L. And that maximal Sharp over columns of L is basically going to equal, if this dimensionality reduction is equal, is going to be the maximal Sharp over X. So what we started with was you don't actually need to observe X. You just need to observe the optimal Sharp over all the X. Right? So again, I said before, you don't really need to observe the time series. You just sort of need to think about them existing for the moment. The downside really is that you have to estimate what this K is. What is this number of latent dimensions that you've moved over? So you have to estimate that somehow. There are tricks that you could use to do that if you sampled X, for example, or you could just swag it and say, oh, I think it's going to be 5 or 10, or you could do a what if experiment and say, what if it were 15? Would this look bad? Would this still look profitable or not? Okay, so that was for the first problem, the very large number of backtests throw away their returns. For the human overfitting problem, this is something that we also ran into in a lot of things that we did. We would set up a very sort of constrained machine learning or machine learning light or just plain old linear regression quantitative system in some area. And after a while, we got disciplined enough to set up the knobs ahead of time and then design an experiment. And so you'd end up backtesting maybe about 1,000 different strategies, and you have the return series, each of the same length t. And so we're going to put them in this t by n matrix X, and we can actually observe this. And you'll also observe a number of features, and you can think of the number of features being like 10 or maybe 50 on each of those assets. It's a smallish number. And we also have access to those as well. So let's put those in an F by N matrix F. So X and F, they have the same number of columns. Each column of those corresponds to one backtest. The rows of X are days, and the rows of F are the different kinds of features. And the idea here was to model the Sharp of each asset or each backtest as some linear function of the features in F. So if you computed a vector of the Sharps over X, so you compute the Sharp ratio of every column of X, you put this in zeta as a vector, we're going to think of that as being some linear function in F. So your features should be defined in a way such that this model makes sense. So for example, you don't want to be able to extrapolate away from the tested features in a meaningful way, because this model obviously will break down. You shouldn't expect that your Sharp will extrapolate. So then the problem becomes, how do we find this vector beta? So we're saying the Sharp is linear in the features, and the loadings or the regression weights are this vector beta. How do we estimate beta, and how do we estimate the error in beta? So it turns out that when n is reasonable, from X you can compute the vector of sample Sharps and the n by n matrix of variance covariance, which I'll call omega. So this is the classic asymptotic result of Jobson and Corky or Andrew Lowe. This just relies on the central limit theorem and the multivariate delta method. In fact, I think the Sharper code that I wrote does this for you. I think, I'm fairly certain. It's called SRVCove, I think is the function. Okay, so once you have that zeta and that omega, it's basically a sample estimate. You can regress the zeta against F transpose, and so you'll get an estimate of the beta hats. And to get the variance covariance around the estimated beta, all you need to know is how regression really works. So regression works by this normal equations thing. You can think of beta as being FTF, quantity inverse FT times zeta. And so just applying the multivariate delta method, the variance covariance around your estimated beta is this awful thing. Probably you want to have somebody else do that computation for you, but anyway, it should be fairly easy to do this. But what you end up with as a result is an estimate of the effects of each of your features. So that's what the beta is. It'll tell you like, oh, if you increase this knob by a factor of 1 unit, whatever the units are, then your Sharp in annualized units is going up 0.1, and so you probably want to maximize whatever that knob is. You'll also get an estimate of you'll get a variance covariance around that beta, so you'll get some estimate of how your errors in that in that beta are related to each other, but you'll also get some estimate of whether those knob loadings are significant or not. So that's all that I have. Oh, yeah. No, that's it. I see your question now. It says, what are reasonable numbers for Sharp? So reasonable numbers for Sharp? Well, it kind of depends. Let's see. The Sharp of the S&P 500, like SPY, is on the order of maybe 0.4. I've seen a paper that said that Warren Buffett's Sharp was something like 0.7. Apparently, James Simon's Renaissance fund had a Sharp of almost 2, I think, for about 10 years, so which is very large. I don't know what. So for in the low frequency space where I worked, everyone would have loved a Sharp of 1.5 if they could have really trusted it. But, again, Sharp is a sample estimate. It's the only thing that people actually see. It's a if you go to someone with a backtest, or it doesn't matter that it's over 100 years or something, they probably aren't going to trust you if you say that's a Sharp of 3. For live trading, it's going to depend obviously on how long you've been trading. The rule is that the standard error is basically plus or minus 1 over n. Well, that's the standard error. So for 1 year of trading, you'll need to have a Sharp of 1.6 or more in order to pass a t-test 95%, or at the 0.05 level. And people kind of intuitively sort of have a feeling for that. So if you've been trading for a year, you really should be aiming for a Sharp of 1.5 or 2. Long term, it's going to be very difficult to achieve that. Yeah, so I was talking mostly about the sort of low frequency space where I live. It was claimed that in high frequency people would only trade, for higher numbers, that they would only accept something that had a Sharp of 5 or higher. And it's a little bit funny because if you think about high frequency trading, there's a very large infrastructure cost that's involved with that. If you're thinking about winning in terms of latency, it's a real arms race, and you're going to invest a lot in your infrastructure. So really, it's kind of like having a very large fixed cost. This R0. Your disastrous rate gets sort of higher, but people only really talk about it as being 0. right? Or maybe they'll put in the interest rate, which is now 0 or negative maybe or something like that. So yes, I think they probably are seeing higher sharps, but they have a higher cost. They probably should have a higher 0, and once they get front run, once somebody else figures out what they're doing or does something a little bit faster than them, then suddenly it's at 0 again, right? Or negative. Yeah, so the question was whether we just put the data through principal components analysis and try to reduce the dimensionality. Yeah, so there is, as part of the paper that I wrote about Cramer-Rao bound, it basically says that as the number of knobs that you have at your disposal increases, if you don't increase the true sharp fast enough, your expected real portfolio out of sample sharp will start to decrease. So that number of knobs is when you go from the unconditional model to the conditional model where you're starting to take features, the number of knobs is really the number of free variables that you're looking at. And so dimensionality reduction would, I think, probably reduce that number of knobs. And so in most of the things that we did, we always tried to reduce the number of decisions that we were making by projecting things along certain dimensions. We wouldn't per se just feed something into a PCA because oftentimes we would have more stocks or more features than we would have days, for example. Or there were ugly things where you had ragged starts and ragged ends, or you had NAs or NANs in there, which was the bane of our existence. Also, a PCA would actually probably be kind of slow for what we were doing. So we were doing genetic programming, and we would generate signals. Signal is just a kind of like you can kind of think of it as a prediction of future price, but it also has baked in the allocations in it. So it doesn't have to do something like Markowitz in order to turn it into a portfolio. You're doing dollar-wise proportional allocations, and then you're going to feed it into a very simple sort of backtester. The generation of those, the backtesting, once you've computed the signal, would take maybe about a second. So you had, I don't know, there maybe be 2,000 stocks over a period of 10 years or something. We could do that backtest in about a second. And that was not even the path independent. That was like the scale independent, or maybe the proportional allocation version of that. They were very fast. We wrote it in C, and we made it as fast as we possibly could because we had to do it thousands and 10,000s, hundreds of thousands of times. So it pushed all the computation over onto the actual generation of the signals themselves. And so you can think of that as a problem of taking a bunch of different time series, combining them together in some way. So you could have certain functions that were unitary maps that would take one time series and produce another, or you could have functions that would take two time series and make one out of them. But PCA would have been much too slow for that framework. So we might have done something like, just do a random projection, which is like the poor man's, PCA. Just multiply it by these, create some random seed such that it doesn't change over time, and then project it onto these things, and then trade on that instead, and then translate it back into the actual manifest shares from that latent space later on. So yeah, we did things like that. Okay, next question. Yeah, so the question was whether we looked into forward testing instead of back testing. Forward testing, I think maybe you're talking about paper trading. Is that right? Or is it? Yeah, so I think that's what we would have called paper trading. So one way to shake out time travel in your system is to run it every day as you would have actually run it. You're eventually going to have to get to that point where you have a deployable piece of code. So create your system, create your basket of trades every day. And instead of trading it, you just record it, and then later on you can look at it and see like, oh, this is what we would have done. This is how well we would have done. Uh, that would have been problematic for us. It would have been far too slow. We're only collecting 1 day of data every day. And so the statistical significance around the effects that we thought that we would see was far too small that we would get anything out of that except after maybe like a year or more. So we would do paper trading to make sure that our system wasn't completely broken. So you would do a paper trade, and then you do that for a few weeks maybe, and then you'd compare it to what the backtest said that you would have done at that point in time. Make sure that those things actually line up. Otherwise you have this sort of HAL 9000 and SAL 9000 problem of your two pieces of code don't agree with each other. So we did it for testing our code, but not really for testing the strategies, if that makes sense. Yeah, that's correct. We did not buy high frequency data. Yes, it's hard to buy good high frequency data. Right, right. So the question was, if you had had high frequency data, could we have gotten a better idea of what our impact would have been, market impact or slippage, and what the fills would have looked like? So I kind of misspoke. We did have some amount of minute data. I don't really consider that high frequency. It wasn't book data. We didn't have access to the how much was sitting at any given level at a given point in time. We just had the same dumb bar data from daily data, but down at the minute level. And we use that to estimate our impact. There are a number of different models for impact, or a number of different papers, shall I say, on impact. And we tried to replicate the results. Uh, it's a little bit funny because um, our theory was that it might depend on the kind of strategy that you were trading. So if you think about a strategy that's a trend following, it might actually be profitable. But let's say you're not the first person in on the trend. Let's say your window of look back is large enough that you don't catch it right at the beginning somehow. So the price is going up. The price is going up. It would have continued to go up whether you bought it or not. You bought it, and it seemed to have gone up in the period between when you submitted your order and your fill, but it would have done that anyway, right? So there's this issue of whether you're riding on a wave like a little boat, or whether you're creating a wake like a big boat. Uh, And that depends on, again, whether you're sort of trend following or whether you're mean reverting. The fundamental problem is that you don't observe, both states of what would have happened had I done this and what would have happened had I not done this. You only observe one of them. And that really would have been the sort of gold standard of figuring out what is my impact. You only get one of them. I don't know whether that answers the question. So the question was whether you can fit a double stroller on the BART. I didn't take BART much. BART is sort of intercity. It goes through multiple counties, and I live and work in San Francisco, so I mostly took Muni. Muni had some awful rules about whether you could take a stroller on or not, which changed in the last 6 years, and then my kids stopped going in a stroller. I never had a double stroller. I only had a single. I'm sure I have seen double strollers on Muni. It's not a great way to make friends. If you're visiting, you should know ahead of time that San Francisco is not, in general, a friendly city for children. If you go to New York and you travel and you go on the subway and you have a kid, people will actually get up from their seats and allow you to sit down and let your 3-year-old child sit down rather than be thrown around. And that will not happen in San Francisco because everyone's designing their next app on their phone or something. So that's San Francisco. Don't have kids or anything. Great. Thank you. Yeah, so the slides of this are on my website, and you can get the link from Chris. Okay, great. All right, thanks. You too.